Next, we're going to talk about non-refundable credits. Non-refundable credits, we look at them as money that you don't physically see, or credits that you don't physically see. A non-refundable credit is a dollar-for-dollar reduction of the tax liability. A non-refundable credit can only reduce the tax liability to zero. So that means it's not going to put any money in your pocket. For example, a taxpayer has a tax liability of $1,000 and non-refundable credit is $1,200. The tax liability then becomes zero and the remaining $200 is lost. Non-refundable credits are shown on the Schedule 3, Part 1. And we have highlighted the ones that we commonly see at our tax sites. Foreign tax credit, not a whole lot. Credit for child and dependent care expenses, Form 1040, line 11, attached Form 1041. Education credits from Form 8863, line 19. Number 4, retirement savings contribution credit, attached Form 8880. Residential energy credits, attached Form 5695. And mortgage interest credit, G. Now, there have been some changes to the non-refundable credits, particularly the child and dependent credit, because a portion of it is now refundable, and the child tax credit. But because we don't know what this is going to look like, we are waiting to go live to see how this is going to actually impact the tax return. Now, the first credit that we'll talk about is the foreign tax credit. This is a non-refundable credit, and you will find it under Part 1, Line 1 of the Schedule C. And you would typically see this on a 1099 INT or 1099 DIV, and we talked about this to a small degree earlier when we was talking about income. But U.S. citizens and residents compute their U.S. taxes based on their worldwide income. Taxpayers who pay taxes to a foreign country or United States possession may be entitled to a credit on their U.S. taxes. Taxpayers who receive Form 1099 INT, Form 1099 DIB, and also the Schedule K-1 may have amounts indicating that foreign taxes have been paid on their behalf by the issuer of the document. So no worries. Once you input that information into TaxSlayer from those forms, it's going to automatically show the tax implication. The next credit that we would like to talk about is the retirement savings contribution. The retirement savings contribution credit is a non-refundable credit eligible taxpayers may claim if they made a qualifying contribution to a retirement plan. If the contribution is tax deductible, such as a traditional IRA, the taxpayer receives the benefit of the tax deduction and a tax credit. And this is rarely done. This is the only time we've seen this in the tax code. This is considered a double benefit. Contributions to a non-tax deductible account, such as Roth IRAs, can qualify the taxpayer for the credit as well. But again, no worries. Information input into TaxSlayer is going to automatically compute this. And you typically will see an amount on the W-2, box 12, and common codes that you might see are D and G. Now, the non-refundable retirement savings contribution is based on AGI, whether you're married, filing joint, and your filing status, married, filing jointly, head of household, single, married, filing separately, or qualifying widower. So, and it's based on a percentage. And this chart will show you how this percentage will show you the percentage. For instance, if the AGI is between $19,750 and $21,500, the percentage is 0.5 for married filing jointly, 0.5 for head of household, and 0.2 for single, married filing separately, or qualifying widower. But again, no worries, TaxSlayer is going to automatically compute this based on the information that was input from your W-2. The next credit that we'll talk about is the, and again, all of these are non-refundable credits, so any excess credit over your tax liability is just lost. We don't see a lot of this at our tax sites, but again, this is just information, and based on the information that you input into TaxSlayer, this will be automatically computed. Individuals who qualify for the elderly or disabled credit have to have meet these criteria: age 65 or older, or under age 65, retired on permanent and total disability, receiving taxable disability income, and under the mandatory retirement age their company has set. And this chart breaks down the income limits based on your filing status and your adjusted gross income, or the total of your non-taxable Social Security and any other non-taxable pension, annuities, or disability income is equal to or more than those amounts listed. Be sure to, there's a note under the software hint, be sure to include the taxpayer's total Social Security benefits regardless of the taxability to ensure the correct calculation of the credit. The software does not calculate this credit automatically. If the taxpayers appear to qualify for the credit, refer to the navigation path on the next page and answer the questions. But once you answer these questions and input the information, then TaxSlayer will do the rest. Another non-refundable credit is the child and dependent credit. And we can't confuse this with the child tax credit. And this is one of the tax credits that I was speaking of earlier, where there's a tax change and where a portion of this tax credit can now be refundable. But again, we don't know how this is going to look until we actually start preparing tax returns. but the child and dependent credit may be claimed by taxpayers who, in order to work or look for work, pay someone to take care of their qualifying person. But there are stipulations. In 2021, for the first time, the credit is fully refundable if the taxpayer or the taxpayer's spouse, if married, filing jointly, had a principal place of abode in the United States for more than 1/2 of 2021. This means that an eligible family can get it even if they owe no federal income tax. Okay, so that's a change. But who is a qualifying person? And we really have to probe and get all of this information from the taxpayer so we'll know what information needs to be input into TaxSlayer. But a qualifying child who was under the age 13 when the expense was incurred and who can be claimed as a dependent. Any person who was incapable of self-care, whom the taxpayer can claim as a dependent or could have been claimed as a dependent, except that that person had gross income of more than $4,300 or filed a joint return, or that the $4,300 or filed a joint return, or that the taxpayer or spouse, if married filing jointly, could be claimed as a dependent on someone else's 2021 tax return. A spouse who was physically or mentally incapable of self-care. And here are some definitions of incapable of self-care. Persons who can't dress themselves, clean, or feed themselves. Also persons who must have constant attention to prevent them from injuring themselves or others. The qualifying person must live with the taxpayer more than 1/2 the year. Qualified work expenses. These are listed below. Expenses must be paid for the care of the qualifying person to allow the taxpayer and spouse, if married, to work or look for work. The care includes the cost of services for the qualifying person's well-being and protection. Expenses to attend kindergarten or higher grade aren't an expense for care. But if they go to after-school care, then that after-school care portion does qualify as an expense and for the credit. Expenses for summer day camp are qualifying, but those for overnight camp aren't. So for instance, if there's a football camp and you have to actually physically stay, then that would not be a qualifying expense. And all of this information can be found on page G10 of the 4012. And again, make sure you have your 4012 readily available, because if a question comes up, if you're at a site, you generally can, talk to the site manager and, get some additional help. But actually being able to research that information and find the answer yourself will make you remember it clearer. Non-fundable credits, child and dependent care. There are 5 tests. The qualifying person tests, and we talked about that under G10. Earned income tests, work-related expense tests, joint return tests, and provider identification tests. On G-11, there is a screening sheet, and you'll see screening sheets throughout the 4012 that can really help you answer, or if you have questions about this particular issue. Earned income is $250 a month if spouse, taxpayer, full-time student, or incapable of self-care. Only the custodial parent may claim the child and the dependent care credit. The credit ranges from 35 to 50% of the taxpayer's expense, and this percentage is based on the taxpayer's income and adjusted gross income. It can reduce the taxpayer's tax to zero, but with the new change, it could result in a refund. The credit is significantly higher this year. The limit is $8,000 for one qualifying person or $16,000 for two or more qualifying persons. For 2020 tax year, up to 50% of the expenses are refundable for a taxpayer who lived in the United States for more than half of the year. And this would be Schedule 3, Part 2, line 13G. And again, this is new. The next credit that we would like to talk about is the child tax credit. And this is different from the child and dependent credit. And this is another one where there have been some changes. And we really don't know how it's going to impact what it's going to look like on the tax return. The refundable child tax credit, and there is a note, make sure the taxpayer's credit hasn't been disallowed. And how will you know this? You would ask the taxpayer in your probing. The expanded credit means the amounts of the credit for the qualifying children will increase for many taxpayers. For eligible taxpayers, the credit is fully refundable, which means that taxpayers can benefit from the credit even if they don't have earned income or don't owe any income tax, which means that's money in their pocket. Taxpayers can receive the credit for qualifying children who turned 17 rather than 16 in 2021. It was 16 for 2020. Eligible taxpayers may receive part of their estimated credit in 2021 before filing their 2021 tax returns. And many taxpayers received that advanced tax credit, $250 per child under age 6 and $300 per child over age 6. And that has to be accounted for on the tax return. So, for tax year 2021, families claiming the CTC will receive up to $3,000 per qualifying child between the ages of 6 and 17 at the end of 2021. They will receive $3,600 per qualifying child under age 6 at the end of 2021. Under the prior law, the amount of the CTC was up to $2,000 per qualifying child under the age of 17 at the end of the year. So this is a new change. The increased amounts are reduced or phased out based on your income. For taxpayers who have income over $150,000, for married taxpayers filing a joint return and qualifying widowers, and $112,500 for head of household, and $75,000 for all other taxpayers. So there is a phase out. Who is a qualifying child? A qualifying child has to be under age 18 at the end of the tax year, a U.S. citizen or U.S. national resident alien of the United States. Child must be claimed as your dependent. Your son or daughter, adopted child, stepchild, eligible foster child, or a descendant of any of them, brother, sister, half-brother, half-sister, or a descendant, don't provide over half of his or her own support, lived with the taxpayer for more than half of the tax year, and there are exceptions if for the time that they live with you, and we'll see those on the next page. And they must have a Social Security number that is valid for employment issued before the due date of the return, including extensions. So children that have I-10s are not eligible for this credit. Now this is new for this year. Just like the stimulus payments had to be reconciled on the tax return, the advanced CTC payments have to be reconciled on the tax return. And they will get a letter, 6419, that contains the information that you will need to input into TaxSlayer. The amount of the child tax credit that can properly be claimed on their 2021 tax return. So you have to do a comparison. And we don't know how this is going to be entered on the actual tax return yet until we actually go live. If the amount of the child tax credit exceeds the amount of the advanced child tax credit payments, claim the remaining amount of child tax credit on the 2021 tax return. And hopefully the software will, once we know how to input it or what it's going to look like on the tax return. If the total amount of the advanced child tax credit payment exceeds the amount of the child's tax credit that can properly be claimed for the 2021 tax year, some or all of that excess payment may have to be repaid. But there is a repayment protection component. Taxpayers qualify for full repayment protection and won't need to pay any excess amounts if their main home was in the United States for more than half of the 2021 and their modified adjusted gross income for 2021 is at or below the amounts listed. There's amount for married, filing jointly, head of household, and single. Repayment protection may be limited if modified AGI exceeds these amounts or the main home was not in the United States for more than half of the 2021. And based on the information input into TaxSlayer, this will be automatically computed. Repayment protection is phased out as modified AGI exceeds the amount above. Repayment protection was equals 0, and the repayment amount will not be reduced when the modified AGI is at or above the higher amounts based on the filing status for 2021. And those amounts are listed based on the filing status. For taxpayers who qualify for repayment protection, the full repayment protection amount equals $2,000 multiplied by the following. And again, TaxSlayer will automatically compute this. And all of this information can be found on 4012, page G5. The next non-refundable credit we want to talk about is for other dependents. And these are dependents that don't qualify for the child tax credit. They may have a I-10, or they may be over age 18. So let's take a look at these stipulations. There is a $500 credit for other dependents who do not qualify for the child tax credit. The dependent must be a U.S. citizen, U.S. national, or resident of the United States. This dependent must have a valid identification number, and it can be an I-10 or SSN. The $500 non-refundable credit is available for dependents who don't qualify for the child tax credit, such as children who are over age 18 and above, or dependents such as your elderly parents, or children who do not have a valid SSN. Taxpayers cannot claim the credit for themselves or spouse if married filing jointly. And there is a note: dependents who are not U.S. citizens or U.S. nationals but are residents of Canada or Mexico do not qualify for either the child tax credit or the credit for other dependents. And that information is listed on the back of the form 1040, let's see what line. Line 19. Now we're going to move into the education credits. And there are basically two education credits that are considered non-refundable credits. However, one of the credits, which is the American Opportunity Credit, up to 40% of it could be refundable. But the Lifetime Learning Credit, none of it is refundable. So let's take a look at some of the guidelines. Taxpayers can take a deduction credit for themselves, their spouse, and or dependents claimed on the tax return who were enrolled at or attended an eligible post-secondary educational institution during the tax year. The time that the person was in school impacts the type of credit that they will be able to qualify for. Now, what is an eligible institution? An eligible institution is generally any accredited public, nonprofit, or private college, university, vocational school, or other post-secondary institution eligible to participate in a student aid program that's administered by the U.S. Department of Education. Let's take a look at the first education credit, and that is the American Opportunity Credit. And this is generally the most advantageous credit for the taxpayer. And we want to first see if the taxpayer meet the guidelines for this credit. And the reason I say that is because a portion of the credit is refundable. But J-5 lists the guidelines. up to $2,500 credit per eligible student. There are income limitations listed based on filing status. Note, 40% of the credit may be refundable. The rest is non-refundable, which means it just reduces your tax liability but does not put any money in your pocket. It's available only if the student had not completed the first 4 years of post-secondary education before 2021. Available only for 4 years per eligible student, including any years the Hope credit was claimed. And that will be listed on in the software. When you start preparing the tax return, you'll have to answer those questions. Student must be pursuing a program leading to a degree or other recognized education credential. They can't already have a degree. Students must be enrolled at least half-time for at least one academic period during 2021 or for the first 3 months of 2022 if the qualifying expenses were paid in 2021. As of the end of 2021, the student had not been convicted of a felony for possessing or distributing a controlled substance. Tuition, required enrollment fees, and course materials that the student needs for a course of study, whether or not the materials are bought at the educational institution as a condition of enrollment or attendance. So these have to be qualified expenses. Room and board would not be eligible for this credit or this expense. Payments made in 2021 for academic periods beginning on 2021 or began in the first 3 months of 2022. Filers and students must have a tax identifier number by the due date of their 2021 return, including extensions. And you have to provide the institution's employee's identification number on the form. And the form that will populate is the form 8863, based on the information that has been input into TaxLayer. Now, there is further stipulations on the American Opportunity Credit, and none of the credit is refundable if 1, 2, and 3 apply. 1, taxpayer claiming the credit is A, under age 18, or B, age 18 at the end of the year, and their earned income was less than 1/2 of their own support, or C, a full-time student over 18, under 24, and their income was less than 1/2 of their own support. And the taxpayer has at least one living parent, and the taxpayer doesn't file a joint return. So these are significant when none of the credit would be refundable. Now, that was the American Opportunity Credit, and as I indicated, a part of that is, of the American Opportunity Credit is refundable, and we'll talk about that a little bit more in terms of where it would appear on the tax return. Now, the next credit is the Lifetime Learning Credit, and it's not as advantageous as the American Opportunity Credit because none of it is refundable. And it's limited to up to $2,000 credit per return, unlike the American Opportunity Credit, $2,500 per child. There are income limitations that are listed. Again, it's non-refundable. The credit is limited to the amount of tax you must pay on your taxable income. It will not result, in a refund if it's more than your tax. And it's available for all years of post-secondary education and course of study to acquire or improve job skills. So the American Opportunity Credit was limited to getting a degree. But if you have, say, a master's degree and you're going to just update your skills or get some additional training, then if it's to improve your job skills, then you would be able to utilize it. So as you can see, some of the guidelines are quite different, but the lifetime learning credit gives you more flexibility. Students does not need to be pursuing a program leading to a degree or other recognized education credential. Available for one or more courses. It does not, felony drug conviction does not impact your eligibility. Tuition and required enrollment fees, including amounts required to be paid for the institution for course-related books, supplies, and equipment. Payment made in 2021 for academic periods beginning in 2021, just like the American Opportunity Credit, or beginning in the first 3 months of 2022. So, you can see that the lifetime learning credit is less restrictive than the American Opportunity Credit, but the American Opportunity Credit is the most advantageous one. Where do we get the information regarding the expenses? And generally, the school will issue a form, and box 1 may include non-taxable scholarships and grant amounts. Some students may choose to pay non-qualifying expenses with scholarship, Pell Grants, making the scholarship Pell Grant taxable. This is even true if the scholarship grant was paid directly to the school. This may increase the amount of qualifying expense that can be used in calculating an education credit. It is best that students and parents bring in a copy of the tax return or get return prepared on the same day. It just makes it the return become more accurate. Now, how do we get this information? It's from the Form 1098-T. This is what it looks like. And again, you have to have the school's identification number. You will see an amount in box 1 as payments received for qualifying tuition and related expenses. And note, it says tuition and related expenses. It does not include room or board. You may see amount in box 5, and that's scholarships or grants. Now, if the amount in box 5 exceeds the amount in box 1 plus related expenses such as books and supplies, then the excess becomes taxable to the student. And we talked about earlier under income the tax implications and how it's reported on the tax return. Now, how will you know if this is a graduate student, which is only eligible for the lifetime earning credit, or if it's a undergraduate student? And box 8 and 9 would be checked. Well, box 8 will tell us if they are either a half-time student or if they are box 8 is checked if they are at least a half-time student. And box 9 is checked if they are a graduate student, letting us know whether they would qualify, the expenses will qualify for the American Opportunity Credit or the Lifetime Learning Credit. And if a graduate student, only the Lifetime Learning Credit. Okay, we're now up to poll question number 27. All of these taxpayers contributed to their employer's 401k plan. Who qualifies for the retirement savings credit based on gross income? A, B, C, or D? The poll has been launched and you'll have a minute to complete it. What is the threshold amount? What is the threshold amount? Do you remember? Okay. We're going to give you a little bit more time. Okay, we're going to go ahead and end the poll. Let's see, how did we do? The correct answer is B, and 55% of us got that correct. And I'll share the results. And the reason it's Sybil is because her adjusted gross income is under the threshold limit for merit filing jointly. And you can find that those limits on G-17. Okay, that's the answer. Sybil and her adjusted gross income is under the threshold limits. We'll launch the next poll question. Poll question number 28. Jose and Yolanda Almeida are married filing jointly and have 5 dependent children under the age of 17. Jose and Yolanda both have a valid SSN. Their children have individual tax identification numbers, ITINs, and those generally start with a 9. Are their children qualifying children for the purpose of the child tax credit? And we need to answer either yes or no. You'll have a minute. Are there many questions in the chat? Okay, we'll go ahead and end the poll. I'll share the results. And we didn't do very well on this question. The answer is no. And why is it no? The children do not qualify for the child tax credit. Remember, they have to have a valid SSN. And since they have ITINs, they will not qualify for this credit. However, they will qualify for the credit for other dependents. Okay, there are the answers. No, the children do not qualify for the child tax credit because they don't have valid SSNs, and they will qualify for the credit for other dependents. Okay, the next poll question number 29. Bob was a full-time student and a fifth-year senior. He has only claimed the American Opportunity Credit for 3 years earlier. Does he qualify for the American Opportunity Credit? Yes or no? We'll launch the poll and you'll have a minute to complete it. Okay, we're going to go ahead and end the poll. Okay, this question was a little tricky, but if you answered yes, and 64% of you did, you are correct. Now, although he is a fifth-year student, because he claimed the credit, he's only claimed the credit in the past 3 previous years. He's pursuing a degree. He doesn't have a degree. And the fact that this is his 5th year doesn't have any implications because he has not taken the credit in the previous 3 tax years. Let me show you the answer. Yes, Bob qualifies for the American Opportunity Credit because he only claimed the credit in the 3 previous tax years. Okay, we'll go to the next poll question. Poll question number 30. Janice works full-time and takes 1 course a month at night school. Some of the courses are not for credit, but they are meant to advance her career. Which credit is appropriate for her? The American Opportunity Credit or the Lifetime Learning Credit? We will launch the poll, and you'll have a minute. Okay, we'll go ahead and close the poll. And most of you got that one correct. It is the Lifetime Learning Credit. And the reason it's the Lifetime Learning Credit, based on the information that was given, she was not in school for at least half. She was, half of the year. She was less than a half-time student. Okay, well, that concludes our session on non-refundable credits, excuse me. Let me just go ahead and share the answer. Lifetime learning.